Today, we will talk about a holding company depository receipt, HOLDR. A holding company depository receipt was a security that allowed investors to buy and sell a basket of stocks in a single transaction, similar to exchange-traded funds, ETFs. However, holders were discontinued and some converted into ETFs by the end of 2011. A holding company depository receipt referred to a fixed collection of publicly traded stocks packaged together as one security. They were created by Merrill Lynch and traded on the New York Stock Exchange. Holders allowed investors to diversify within a specific sector at a relatively low cost. Unlike ETFs, investors and holders had direct ownership in the underlying stocks, providing voting and dividend rights. Holders are often compared to exchange-traded funds, but they are different investment vehicles. ETFs invest in indexes with many components, regularly changing, while holders were a static group of stocks selected from a particular industry. ETFs also tracked an underlying index and were adjusted to provide the best return, whereas holders did not. Holders were typically bought in round lots of 100 and could be capital-intensive for smaller investors. In 2011, 6 of the 17 remaining holders were converted into ETF structures, and the remaining 11 were liquidated. Here are 3 key takeaways. 1. A holding company depository receipt, HOLDR, was a security that allowed investors to buy and sell a basket of stocks in a single transaction, and were discontinued by the end of 2011. 2. Holders allowed investors to diversify within a specific sector at a relatively low cost, and provided direct ownership in the underlying stocks, unlike ETFs. 3. Holders were often compared to exchange-traded funds, ETFs, but were different investment vehicles, and 6 of the remaining holders were converted into ETF structures in 2011. Hope this would help. Thanks for watching.